precedes regulation, as we can't regulate what doesn't exist. Government of India cannot agree with me more on this. You ask me how? Let me explain with an example.
Accordingly, for the taxation of virtual digital assets, I propose to provide that any income from transfer of any virtual digital asset shall be taxed at a rate of 30%, 30%.
This was our finance minister delivering her 2022 union budget speech, and I am here to simplify the innovation, in this case cryptocurrency, and the regulation which followed it. A very warm good morning to all the respected dignitaries, members of the jury, and my professional friends. I am Vanshika Giriya, and my topic for today's presentation is taxability of cryptocurrency and the regulation which followed it, and the emerging issues in tax law. We all have just heard what a finance minister said on 1st Feb 2022. Now, let's see how the industry reacted to it. And not to our surprise, we saw mixed reactions. For some, this tax came as a welcoming move because it took away the fears of an outright ban of crypto. Whereas some found the tax rate harsh and hashtag reduce crypto tax went viral on Twitter. Do you have any crypto investors in the house? Sir, can you please stand up? You also raised your hand, right? A general question to both of you. Under which school of thought do you belong to? 30% इसे एक बार accept तो किया यार, या ego ला पे अब हमका नहीं रहना. 30%. Okay, thank you so much. But I completely believe, with due respect to your views, I disagree because I believe the tax rate is way too harsh. So, in general, the impact of this regulation is always subject to debate depending on who you ask. But as taxation experts, we all need to understand the intricacies behind this tax. And to begin, let's first address the elephant in the room. My next question to you. Can you tell me any one word that comes to your mind after listening to cryptocurrency? Anything, even a single word works.
Bitcoin.
Bitcoin, nice. Blockchain. Digital payments. Okay, so summarizing everyone's viewpoint, cryptocurrency is a form of digital currency which uses cryptography to secure transactions. Cryptography is a technique of securing transaction by encrypting the information which can only be decrypted by someone who possesses a special key or a secret key. It is a peer-to-peer payment mechanism without the use of any third-party intermediary. Some common examples of cryptocurrency include Bitcoin, Ethereum, or Ripple. Now that we know what is cryptocurrency, let's move forward and understand why is taxation on cryptocurrency necessary. Crypto gave financial crime, money laundering, and tax evasion a room to flourish. A recent report by Times of India stated that cryptocurrency-based crimes hit an all-time high in 2021 at $14 billion, a 79% increase from previous year. As per Anderson Horowitz State of Crypto Report 2022, it states several parameters which indicate that cryptocurrency and its economy is booming at a rapid pace. After all this, how can any government miss on this huge source of revenue? And that's how a finance minister decided to include under the purview of income tax. Now, as Sir had just mentioned in the beginning, we'll just run through the major amendments made in income tax related to cryptocurrency. Number 1. Virtual digital assets have been defined under Section 2, Clause 47A. Income tax at the rate 30% has been made applicable on transfer of VDA. VDA stands for Virtual Digital Asset. TDS will be deducted on consideration paid to resident on transfer of VDA. Number 4, gift provisions have also been made applicable. Lastly, the budget speech also addressed central bank digital currency, which will be launched in 2023. Let's start with understanding what are virtual digital assets. Virtual digital assets essentially means a subset of all digital assets that exist on a blockchain. These include crypto assets, non-fungible tokens, or any other digital asset. Here, non-fungible token means a digital asset that exists on a blockchain and whose authenticity and ownership can be verified. The residual category has been kept to include or exclude any virtual digital asset, any digital asset from the definition of virtual digital asset. Let's start with understanding the income tax provisions on crypto. Finance Act 2022 has inserted new provision under section 115 BBH, under which taxation on income generated from transfer of VDA will be taxable at the rate 30%. Let's understand the salient features of this section. Number 1. The provision is applicable from financial year 22-23. It begins with a non-obstante clause, which means that notwithstanding anything contained in any other provision of this act. Number 3. The tax will be levied at the rate 30%. Number 4. Subsection 2 of this section states that only cost of acquisition will be allowed as deduction and no other incidental charges will be permissible to be deducted. Number 5. Set-off of loss on transfer of VDA is not allowed, and carry forward of loss is also not allowed. Further, it's also important to understand the categorization of VDA under this section. By now, we know that this section is applicable on transfer of virtual digital asset. Please focus on the yellow highlighted part. So, we are all CA inter qualified, and we know that transfer has been defined under section 2, clause 47. But the way it has been defined there is very restrictive in its approach to capital assets only, due to the existing of the words in relation to capital assets. So, in order to expand the scope of taxation under this section beyond capital assets, subsection 3 was inserted, which states that transfer for this section shall apply to any virtual digital asset irrespective of its nature or categorization. Next, we move to another interesting concept, that is gift of virtual digital assets. Again, CA intermediate qualified, we know that the gift is taxable under section 56, subsection 2, clause 10. When there is a receipt of sum of money, any immovable property or any property other than immovable property, when the transfer is made for inadequate consideration or without consideration. So for taxability under this section, government included crypto in the third category, that is any property other than immovable property. But the existing definition of property does not include virtual digital assets. Hence, an amendment was made to explanation B of section 56 to 10. After this amendment, the expression property will have the same meaning, but for this section, it will include virtual digital asset also. Next, we shall discuss one of the most controversial provisions in the crypto taxation. Starting July 1, a 1% TDS will be triggered under section 194S when any consideration is paid for transfer of VDA. I call it controversial because crypto exchange executives, lawyers, and tax analysts all believe that this provision will suck liquidity out of the market, whereas government believes that it will help trace transactions and also also reduce financial crimes. A subsection has been inserted under this section, which states that it provides a threshold limit wherein if a consideration is paid to any specified person in a particular year, in a financial year, and it does not exceed 50,000 rupees, and that will be to any person other than a specified person, if that does not exceed 10,000 rupees, then TDS is not required to be deducted. Here, specified person, voice echo, here specified person means any person who does not have income under the head PGBP, or if there is any income under the head PGBP, then business income should not be more than 1 crores, and that from profession should not be more than 50 lakhs. Now that we have learned taxability under income tax, TDS, gift provisions, it's time to jump to GST. Tax in what will further dampen the mood of crypto investors in the economy. The Goods and Services Tax Council, that is GST Council, is mulling a 20% tax on cryptocurrencies, which will bring it at par with casinos, betting, and lottery. It is important to know that already 18% tax has been levied on crypto exchanges as they provide financial services. In this section also, it is important to understand the tax treatment and nature of VDS under this section. But as per a recent 9th June 2022 dated article by Deccan Herald, the GST committee is itself in a dilemma on this issue, that is on categorization of VD under GST, and this shall become a mainstream conversations once there are more developments in the regulatory framework. So, for now, we move forward and understand the emerging issues or the hurdles in practical implication of this tax regime. I'll cover only 6 of them, but as Sir said, there are many more. Okay. Number 1, there exists no clear mechanism to arrive at the value of VDA. Number 2, guidelines are required to identify the place of origin of crypto income. Number 3, crypto shall be taxed under which head remains a burning question, and more clarity is required on the same. Number 4, whether indexation benefit under section 48 will be available for LTCG on VDS, the question remains unanswered. Crypto exchange and investors may face difficulty in maintaining records for TDS and computing income tax credit. The budget does not address cryptocurrency mining, staking, and taxability of crypto miners. Much of the regulatory framework is still developing, and hence industry expects government to provide more clarity on this. Lastly, to conclude, I will say that from fears of an outright ban by RBI to getting mentioned in the union budget, cryptocurrency has come a long way. But the finance minister has also specifically stated that taxing cryptocurrency doesn't mean that it is legalized. Income Tax Act considers tainted income as well as income earned from illegal means alike, and both are taxable under Income Tax Act. To conclude my speech, I would like to amplify what Ashish Singhal, CEO of CoinSwitch, a crypto exchange, said at World Economic Forum recently concluded at Davos. India needs cryptocurrency rules to resolve regulatory uncertainty, protect its investors, and boost the crypto economy. In my opinion, tax policy should be neutral such that it is formed on the basis of its economic merits and not for tax reasons alone. The regulation of this new sector requires international coordination, engagement from industry participants, as it provides an opportunity for progress. That was all from my end. Thank you for being an attentive listener.